Hello, everyone, and welcome to today's webinar, How to Find the Right Private Equity Partner for Your Business. Before we get started, I would like to go over a few items so you know how to participate in today's event. You have joined the presentation listening using your computer speaker system by default. If you would prefer to join over the telephone, just select telephone in the audio pane, and the dial-in information will be displayed. You will have the opportunity to submit text questions to today's presenters by typing your questions into the questions pane of the control panel. You may send in your questions at any time during the presentation. We will try to address them during the presentation, but if we do not get the opportunity to do so, we will collect them and address them during the Q&A session at the end of today's presentation. I would now like to turn the webinar over to Sylvie and Cheryl.
Thank you very much, and welcome everyone, and thank you for joining us this afternoon. My name is Sylvie Guedant. I'm a partner at Citrin Cooperman. I also have the privilege to lead our M&A advisory service practice. I'd like to welcome Cheryl Moss, who's a director at Franz Kohler. I will let Cheryl introduce herself in a few minutes. Cheryl and I co-authored an article earlier this month, which appeared in the Citrin Cooperman corner of NJBiz. And the topic was how to identify the right private equity partner for your business. And we've received so much feedback, from our clients, from our contacts, and a lot of my partners have reached out to me. And we thought that we should turn this into a webinar. It's more interactive. You all have the opportunity to ask us questions directly. And Cheryl and I are very much looking forward to your feedback on our topic. The article in this webinar was really meant for owners of small to mid-sized businesses which are looking to take the next step to growth. Whether it's possible that you're looking to expand to the West Coast and buy a competitor, or maybe you're looking to turn around a business line, or maybe you want to take on a partner to help you grow internationally, or even maybe you're just looking to refinance debt. So you have options, and what we think is one of those options could be private equity, and maybe it should be private equity. So what we're doing with this webinar is not just educating some of you that may not be familiar with the private equity model, but also providing some specific tips and advice and practical approach as to how to find the right private equity partner for your business. So if we go to the next slide, what we're going to do is quick introductions about our firm, and I'll start with Citrin Cooperman. Some of you may know Citrin Cooperman, but for some of you that may not know our firm, we are the 22nd largest CPA firm in the country. We were founded only a short 36 years ago, and interestingly enough, we've actually grown through mergers and acquisitions and taking on lateral partners. Our firm started providing accounting services to very well-known rock bands, so we have a very interesting history. But really, we've grown so much, and even though the entertainment practice is still pretty large today, we really do everything and anything. We are a full-service firm, audits, tax, advisory work, and we do it all, and we do it all for everybody. So we provide work for mom-and-pop shops, privately held businesses, public companies, large multinationals, and we are called a super regional firm because we're headquartered in New York City and have offices in New Jersey, Connecticut, and Pennsylvania, but we are continuously looking to extend to other markets through mergers, so you may see us in other states. In terms of what I do and what my team does, I work with private equity funds and their portfolio companies. We provide buy-side and sell-side advisory services, including doing due diligence on acquisitions, preparing a company for sale, providing tax structuring on transaction, and we focus on what we call the lower middle market, which is companies like probably many of you have a few $1 million of revenue to a few $100 million of revenue, and we cover every single industry vertical, whether it's manufacturing, distribution, real estate, staffing, service businesses, healthcare, technology, commerce, franchising. I can go on and on. We do it. I want to actually acknowledge that we received 2 M&A awards this month. One of them as recently as last week, We were named the CPA Firm of the Year by the ACG New York Champions Award, and we also received another award for excellence in buy-side and sell-side due diligence services by an international organization. Enough about Citrin Cooperman. I want Cheryl to introduce herself and Friends Scholar.
Great, thanks, Sylvie. My name is Cheryl Moss. I'm a director at Friends Scholar & Co. Friends Scholar is a New Jersey-based boutique private equity investment firm. We invest generally in companies that generate $10 to $100 million of revenue, are growth-oriented, and in general, we look to invest anywhere from $3 to $20 million of equity capital in each deal that we do. We invest in both controlled buyout transactions as well as in minority growth capital raises. We invest in transactions that involve leverage as well as debt-free transactions as appropriate. But we do look to invest in the equity part of the capital structure. In terms of industry, we're what we refer to as generalists, and we're quite opportunistic. But as with, I think, all generalists, we do have areas where, as a firm, we have a great deal of domain expertise. And those verticals broadly would be consumer, business services, manufacturing, and distribution. And then as we get more specific within each of those broad verticals, we certainly have areas where we've done a number of deals and also bring to the table some deep day-to-day operations expertise. As we'll discuss a little bit further in the presentation, one thing that we look for in the deals that we do is certainly an opportunity for growth, opportunities where our skill set and backgrounds are a good fit for the particular investment, cases where our involvement can accelerate the growth of a particular company. And the other theme that is common across all of our history and all of our deals is really an opportunity to partner with an excited and an entrepreneurial management team to help them grow their business. We've been around for almost 30 years now in some form or fashion. The principals who continue to run the firm today and are very active in all of our activities began their careers as owner-operators of companies. And so for those of you on the line who are day-to-day operators, Friends Scholar is an investment firm who knows what it's like to sit in that seat. And we believe that operational background is pretty unique and equips us to be a good, valuable partner investor to the companies that we invest in.
Okay, great. What we wanted to do now is open up a polling question. We only have one question. It's really to give us an idea of who's listening today. So what we want to try to know is, what represents your need for capital. We have 5 options, and unfortunately you can only select one, but try to select the one that represents your situation the best. So here are your options. A, growing a business organically or via acquisition. B, investing in a business. C, diversifying. D, buying out a shareholder. Or E, refinancing debt. And I will give you a few, maybe 30 seconds about to answer those questions. Another maybe 10 seconds to make sure everybody has a chance to answer. And then we'll show the results. All right, great, fantastic. So a lot of you are looking to grow, and what this webinar is really about is about growth. Is about taking your business to the next level, and as you need to do that, you're going to need access to capital. And again, as I mentioned in the beginning, is private equity a good option for you? And we want to talk to you about that. So a couple of things that I know I hear a lot from business owners, and my partners hear the same thing, is when we discuss private equity as an option, there are two things that come up pretty regularly as answers from business owners. Is one, my company is too small, or two, well, if I take on a private equity partner, they're going to want control, and I don't want to give up control. So, Cheryl, as a private equity investor, how do you respond to those, two conceptions about private equity?
Sure. Well, I think that the first thing to point out is that there's certainly a wide variety of investors in the market, all of whom have different types of investment criteria around the metrics of size, structure, industry, stage. And so I think that the question for most business owners is not, can my company attract private equity capital? Because I do believe that the vast majority of companies can. The trick is instead to find the right fit private equity capital partner for your business. Of course, if you're a $15 million revenue company, you're probably not going to call KKR for growth capital investment. And KKR is, if you're not aware, is Kohlberg Kravis Roberts & Co. It's one of the largest buyout firms in the industry that typically does, as large as multi-billion-dollar deals. You should be calling on firms that focus more on the size of your company, and then narrow down the criteria from there. So I think it's really more a question of finding the right fit partner, not the binary question of does my company fit the criteria? Because I think odds are there are investors out there who would find your business attractive and have an angle that would be appropriate for your business. So the doubts that Sylvie mentioned that she sort of hears from her client base, I think coalesce around a few themes, and I boiled them down to three. It's size, structure, and cultural fit with an institutional investor. So let's flip, if we flip to we're already there, slide 6, we can walk through each of these. So the graphic at the bottom of slide 6 illustrates the spectrum of investors who would seek to invest in private equity capital, or seek to invest private equity capital, rather, with investors focused on the startup and early stage companies on the left-hand side, and then the graphic shifts to the right as the target stage is more mature. So let's start out with size. I think most of the companies represented by the attendees on the call today are small to mid-sized businesses, and I can definitively tell you that there are private equity investors out there who may invest as little as $1 to $2 million. Candidly, Friends Scholar, we state that we have a minimum investment size of $3 million, but for the right opportunity with the right growth trajectory, we would certainly look at an opportunity to invest a smaller amount, especially if that meant there would be a follow-on investment opportunity down the road. Some firms do have minimum check sizes, and I think that's an important question to ask for anyone looking to raise capital. Some firms have a minimum of 10, some of 25, and so you just need to find the firm that focuses on investments in your size range. Generally, investors focus on earlier stage deals are willing to write smaller checks. That certainly follows logic, but the smaller check deals, I think generally you're going to attract a lot more attention if your company represents more of a hyper-growth opportunity. And happy to answer any questions around that if folks want to explore that further at the end. From a structural perspective, again, there are investors out there who require control, meaning they require that they invest and own more than 50% of the company, while others are flexible on this point, and some investors look to avoid control and only invest in minority equity. Generally, again, in general terms, earlier stage deals tend to attract growth capital or minority capital. In fact, many investors who are focused on very small early stage deals do not necessarily seek control. And then the last point that Sylvie mentioned, where business owners sometimes have doubts whether or not private equity would be a good fit is just around the cultural fit of an institutional investor in what today may be a family-owned or management-owned business. I think there are oftentimes misconceptions about institutional investors who look to bring their own people into a company after they make an investment and change the culture. There are investors with that strategy. But there are other investors who really look for situations where there would be continuity in management. So again, you know, it's not a one-size-fits-all game. It's looking for the right fit investor across a multitude of dimensions. So something you might be thinking is what if I own a company and my capital need is small, but my company isn't necessarily early stage and doesn't necessarily represent a hyper growth opportunity. And when I say hyper growth, I mean companies that are doubling and quadrupling year over year. So you know, if your company is small, the check need is small, and you've been around for a while, but you're kind of a nice steady Eddie business, growing at a lower growth rate, maybe 5 or 7%, that doesn't necessarily mean that you're not a candidate for a private equity capital investment. It just might be a different type of private equity capital investment. So I think you need to ask yourself, what is the capital going to be used for, and is there a case for a compelling return on that round of capital? And then as you think through this further, you know, certainly focus on what investors might be looking for. You know, how sustainable and how steady is the growth? Do you have a defensible market position or a unique product? Find the investors who are aligned with your industry or have past deal experience in your industry, and kind of understand that the growth rate that your company exhibits is compelling and superior perhaps to maybe some other data points in the space. Perhaps your company has a strategic fit with something that's already in an investor's portfolio, and so they would look at it as a strategic deal perhaps as opposed to a standalone deal. And then of course, maybe there's an interesting exit opportunity for the investor if they came in and bought your company and helped you grow it over a period of time. The next stage of growth might be a point at which a strategic buyer could be interested, and strategics often are able to pay a premium valuation for a business. So there are, as I mentioned before, there are many, many dimensions around which you should focus when trying to find the right private equity investor. And the last thing I'll comment on this slide is that the graphic at the bottom of page 6 is not all-encompassing. There are other types of investors out there who would have an interest in investing private equity capital across multiple different stages. And one type of investor, as an example, might be a high net worth individual or a family office who does late stage growth in middle market, traditional private equity buyouts, but also would be interested in providing seed capital to an exciting growth opportunity. So please don't take this list as being all-encompassing, but it's a good place to start.
Very good. So in terms of next step, if you're looking to start talking to a private equity fund and starting to venture into a capital raise, one of the questions that actually came up, which we're going to answer right now, is, you know, should you use an advisor or not? Or is there a value to that? And what we say is, you know, we build a team of advisors around you. It really depends on who you are. If you're a serial entrepreneur and you've done a lot of transactions and you feel comfortable negotiating for yourself, that's great. But I'd say more than likely, you know, the best way to go is to really surround yourself with a team of people that have done this a lot and can negotiate on your behalf. So the number one player would be hiring an investment banker. And I'd say, you know, the best thing you can do is hire somebody that knows your industry really, really well, because they can do a couple of things. It's one, they can educate you about what valuation you can expect, you know, who are the players, who's buying companies like yours or investing in companies like yours. The other thing that they will do is that they can represent you and your interest in negotiation. If you deal with private equity investors, you know, all of my clients are really sophisticated deal makers. done a lot of deals. So really, you want somebody on the other side of the table that represents your interests and can do the best job possible to get you the best deal possible. And really, you want somebody that's done it a lot and done it with your industry. The other thing that you have to think about hiring an investment banker, and we are not an investment banker. We're a CPA firm, so I'm doing a free commercial for all the bankers out there. But in case, the key thing about hiring somebody to manage the process and the transaction is that you need to keep your eye on the ball, which is your company. Your company has to perform during the deal process. There are a number of situations where we started due diligence, and unfortunately, sometimes the diligence process may take a while. And the thing is, if it takes a while and you see that the performance of the company is slowing down for whatever reason, it could be because you're spending more time on the deal and meetings, negotiation, and maybe not enough time on your company. So the key thing is really hiring good help. It starts with an investment banker. You're also going to need a seasoned M&A attorney to represent you and make sure that the purchase documents are properly drafted. You will have your CPA firm engaged as well to understand, if you're selling a piece of your company or your entire company, you want to understand how much cash will you get from the transaction, because you can't take the gross amount and think that's the number that will end up in your bank account. There is tax implications, and you need to be fully aware of how much this is going to be. I've seen a number of deals also where the owners were not very well advised by their CPA firm, and it's more than likely they were involved in a later stage of the process. So they did the tax calculation and figured out, well, the actual amount that the business owner was getting was much smaller than they had expected, and they started to try to recut the deal, which is not something you want to do down the line. So at the end of the day, and I know every advisor costs money, but really it's money well spent. You will get more value for your business by surrounding yourself with the right team of advisors. The other thing that should be done is, the next slide, is talking to potential investors, and Cheryl, what can you tell us about that?
I mean, I strongly recommend that anyone who is embarking on this process of raising outside capital and considering private equity is that you reach out to a broad group of investors of different types, of different sizes, all within your size range, but folks with different styles and models to determine what might be the best fit for you, and also help you get your bearings in this world of institutional capital, which you may not have been very familiar with up until this point in time. And the great thing is that institutional investors are always looking for exciting, growing investment opportunities, and would be very receptive to having such a conversation. Members of your team from the different types of firms that Sylvie highlighted can certainly point you in the direction of a few firms to get you started. But think about having this conversation, or having a series of conversations, as an opportunity to really look at the other team's playbook. Through these conversations, I think that any business owner will get unique perspectives on a variety of things, including how different types of private equity investors interact with the companies they invest in. Do they simply participate in board meetings? Are they in regular and frequent contact with their management teams? Do they look to augment a management team? Do they look for management teams that are already complete? How do different investors define success? What are their core values, and do you share those values? And are these different? Is this an investment group who you think you could work with over a very long period of time? Feedback from these you'll receive feedback from these conversations, which will give you some insights into how an outside investor would view your business. What do they view as your business's strengths? What do they view as your business's weaknesses? And this would also give you a heads up as to perhaps some areas where you can clean house and you can address these weaknesses prior to formally going to market and raising capital. And you also may be able to garner some general guidance on how an investor might value your business or structure an investment in your business, and you can compare this with your expectations or your needs around those particular metrics. Through these conversations, you'll inevitably find investors who are a great fit, and you'll also find those who you'd rather not meet with again, and that is perfectly fine. You may even find an investor who you stay in touch with over a long period of time, and that investor could get to know your business quite well, and so when the time comes for you to pull the trigger on a capital raise, it could make the process just a lot easier because that particular investor has a longer-term relationship with your business. Just as a case in point, Friends Scholar made an investment, a control investment in a branded consumer products company back in 2006. It was a company that we met at a trade show several years before that and kept in touch very closely with the ownership team and the management team, became quite familiar with the business and its products and its market position. And when it came time for the company to pursue a sale, they hired a sell-side intermediary to help facilitate the process, but gave Friends Scholar an opportunity to really have an advantaged position in the process, which we were happy to have, but it also made the capital raise process go more quickly and more smoothly for the selling shareholders. I'll conclude this point just by saying that the community of professional investors is new to many business owners. You don't know what you don't know, and you should certainly take this opportunity to meet with investors and gain what you can from these conversations. But in doing so, I encourage you to ask about the potential investor's background and current portfolio holdings. Get a sense for what industries they're already active in, especially if they're invested in one of your competitors, and whether or not they're operating in your industry currently. Certainly put in place a confidentiality agreement. It'll allow you to have a more free-flowing conversation and really get more value from the discussion, and also obviously offer you and your business the appropriate level of protection.
Great. If we go to the next slide, we have a couple of pointers. It's really when you start bringing in capital and having somebody else involved with your business, more than likely there's a little bit of cleaning up that you will have to do to make your company presentable for a potential investor. So we have a couple of pointers and things that we learned over the years. I'd say the two things that are selling points is transparency in organization and deal process. And those two things you have just to keep in mind. So transparency is, for example, addressing potential deal breakers early. And I'd say what you should do about it is, before you start a process and having somebody else do due diligence on you, you should be doing due diligence on yourself. And it could be that, again, going back to the comments we made about hiring a team of advisors, it's hiring somebody that's done it before and can look at your company and take a look at potential issues that somebody would see that you may not see or may not be aware of. So it said do due diligence on yourself and address potential deal breakers early. You don't want this to be a surprise when the deal process starts, that you're, something comes up that you didn't know about. So do due diligence on yourself and address those issues early on. And also, maybe you want to communicate to your potential investor that, these are the things that you picked up and those have been addressed and you can move on. A couple of other things to think about is a lot of private equity funds like to have a strong management team in place. So you have to think about potentially locking in your key management team members or maybe some key employees. That's something to think about. What I'd like to talk about is, because I'm an accountant, I'm a CPA, is talking about financial results. There's a couple of things that you have to think about. Is the first thing is most companies that we do due diligence on are may not have any type of need for audited financial statements or even reviewed financial statements. So a lot of times those businesses are run either on a cash basis or focused on minimizing the tax or maximizing after-tax cash flow, I should say. So a lot of times those numbers have to be recasted. One of the things is making sure that the numbers are in accordance with accounting principles that are acceptable in the U.S., what we call U.S. GAAP. That's one. The second thing is you also have to figure out what your normalized earnings are, what your earnings are after some maybe one-time or non-recurring adjustments. And your investment banker will help you with that exercise, but I'd say you should have your CPA firm involved with that or hire a CPA firm that's done it before. Because you want to know, again, these numbers will be presented to a potential investor, and you want to make sure that those numbers are rock solid and cannot be questioned. So you have to think of recasting your financial results. One of the things that a lot of questions that, again, business owners that are starting to go through the process ask us is, do we need audited financial statements if we don't have audited financial statements already? So do you need audited financial statements? The answer is, you know what, it's probably better, but at the same time, I've seen plenty of transactions, especially in the lower middle market space, again, companies that have a few $1 million to a few $100 million in revenue. I've seen plenty of instances where the deal went through without audited financial statements. Now, what we've seen, though, we've seen a trend of doing a due diligence report on yourself, which we call a vendor due diligence report, and that's something that you may want to consider doing. A couple of other points before we close this slide is you have the opportunity now to improve your bottom line, and that means really improving the valuation of your company. So think about, a couple of things that we talk to our clients about is, when was the last time you increased prices? Can you increase prices? Have you considered getting rid of unprofitable accounts or customers, selling off lines of business that don't make money? All of that will increase your valuation. Have you thought about, strengthening your balance sheet, cleaning up your inventory, shortening the collection process? You collect your AR faster. You have to think of all those things now because they will make your company cleaner, easier to sell, and on top of that, will increase your valuation. The last point is organization is key. During the due diligence process, you will be requested, you will be asked for thousands of documents, and you want to make sure that you have that ready to go. So I'd say, start creating a mock data site. Again, work with your investment banker and start working on the, building a data site. The next slide is about, smart private equity capital investment. Cheryl, if you want to speak about that.
Sure. So the title of this presentation is How to Find the Right Private Equity Partner for Your Business. And so far we've talked about finding the investor whose investment criteria matches up with your business and your situation, as well as how to prepare for raising capital. But I think it's important to highlight that, capital is a commodity. There are many diverse sources from which a business owner can raise capital, but raising capital from the right fit partner and a smart partner can make a very significant difference in the long-term success and long-term value of your business. So let's walk through just an example. You're an owner of a branded cookie company. It's lunchtime, so cookie seems appropriate. And the company is growing steadily, but slowly. Let's say it's a 5 or 7% annual growth business, and you're generating maybe $20 million of revenue and $3 million of cash flow, and you want to raise $7 million of growth capital from a private equity partner to fund a more aggressive marketing campaign, maybe enter some new markets, make some key sales and marketing hires, and you think if you upgrade your baking facility, you can really increase your profit margins. And so you go to market, you do all of the things to prepare that we've talked about, and you found 2 private equity investors who have an interest to invest in a $7 million growth capital raise for a $20 million revenue company in the cookie space, and they have experience investing in companies of your size, and you're generally comfortable with that, with fit on that metric. So Let's assume that they both make similar proposals around valuation and structure. How do you choose which one is the right fit for you? How do you determine which one is smart? Presumably they're both smart, but smart in the right way and smart in a way that will serve you and your business the best. So some of the criteria to consider are, I think first and foremost, personal and cultural fit. If you plan on running the company and maintaining a meaningful ownership stake in the business going forward, is this investor someone you want to be in business with for 5 to 7 years? And what is their intended involvement in the business? And does that match up with your expectations? Do you want an investor? Do you think that an investor who is not going to be very involved in adding value or in regular business, board level business decisions? Or do you want someone who maybe can bring a little more value to the table? If you don't see yourself working with one or both parties through a due diligence process, it's probably not a good idea to take money from either of those parties, because you will be wed to them over the period of their investment. Look at their experience. Does the investor have a track record of experience generally? And more importantly, have they demonstrated a track record of success in your industry, and understand the ingredients to that success, and what factors they influence that weighed in on those successes versus factors that may have been coincidental. Has the investor shared any unique insights or ideas about your business with you, and how might they contribute unique ideas and perspectives post-closing? Do they have relationships that can be leveraged? For example, perhaps one or both of the investors knows the buyers at grocery and mass retailers and can represent and bring to the table some interesting new customers for your business. Or perhaps the investor has relationships in ingredient sourcing and can negotiate improved ingredient pricing for your business going forward. Relationships and experience like this can add very significant value to your business, and having an investor with this background on your team can certainly accelerate the growth and profitability of your company over the period of their involvement. So let's say that the right fit smart investor comes to you and has a lower valuation, or maybe a less desirable structure on the table, and you're faced with this decision to take maybe a slightly less favorable deal today in order to bring on this, the best fit and the smartest partner to your team. At that point in time, it just becomes a question of, weighing the value that you think that investor can bring to the table, and will that value significantly accelerate the growth and value of your business over the next couple of years. For example, if it's a slightly less favorable deal, but the smart investor and the right fit investor can grow your company twice as fast than you can on your own, or the competing bidder can, then my recommendation would be certainly take the lower valuation today, because it's not relevant. When we talk to business owners in situations where we're doing a recapitalization, we often look for opportunities where perhaps the shareholder's taking some liquidity today, but our goal is to make sure that their smaller equity stake in the business in 5 years is worth multiples of what their cash out is today, and they generate that return in 5 years through a lot of hard work, obviously, but also some additional value that we can bring to the table that enhances the value of the company. So if you flip to the
we actually have a follow-up question on this. In the example with the $7 million raise, would this be a minority or majority position?
That's a great question. I intentionally didn't get very specific on that, because if we flip to the next slide, we'll talk about control versus minority deals. So let's tackle that now, and we can use the cookie company example, or the examples that are on this slide as well. As I mentioned before, there are investors out there who will invest in minority only or control only, or some investors that will do both. And different investors have different perspectives on that topic. the needs or desires of the business owner and the situation around the capital raise will often determine whether a minority or controlled deal makes the most sense. So in the case of the cookie company, just based on the numbers I made up, $20 million of revenue, $3 million of cash flow, and a $7 million capital raise, I'd venture to guess that in that situation, I was kind of envisioning a minority growth capital raise, but it doesn't necessarily have to be. And some factors that determine whether or not it would make sense to be a minority or a controlled deal would obviously be, the quality of the management team. Is it a full management team, and is the control shareholder one that is involved enough where a minority investor can get comfortable? But if you look at slide 11, there are two examples laid out. The 55-year-old business owner who wants to retire in 5 years, but maybe wants to pursue a transaction today. Me as an investor, a lot of other things will weigh into my decision on whether or not a control or minority deal makes sense. But I think just in broad strokes, a control deal probably makes the most sense in this case, because in 5 years, I'm going to be thinking about exiting this deal, and having a retiring executive sometimes can cause a challenge in a transaction. And so I think I would want to have control and help to steer the company over the next 5 years and facilitate that transition. It doesn't mean that a minority deal wouldn't work, but that's the kind of situation I think in broad strokes that makes the most sense for a control deal. In the second example on the slide, a young consumer products company needs capital to grow. It's a rapidly growing company. It's young, so probably, perhaps the founders are the ones who seeded the company and are running the business today. If they wanted to retain control and bring on some growth capital to, again, explore some new sales channels or develop new products, and the capital is going to stay in the company and not go into the shareholders' pockets, I think a minority deal in that type of a situation could certainly make sense. From different firms will take different perspectives. I mean, from the Friends Scholar perspective, we invest in both control and minority deals. Obviously the structure of the transaction has to be appropriate for the deal, but at the end of the day, as an institutional investor, we're not running the company day to day. We don't have the vendor and the customer relationships. The management team, and in most cases, the management team also owns a pretty significant equity stake in the business. Whether or not we own 49 or 51% of the business, we're not looking to step in and run the business. So, we need to have a good, solid management team in place. We have to have a certain level of comfort, and then, structure kind of comes second. The first question is it a good deal? So flipping to the next slide, some considerations when you're evaluating control versus minority deals. Obviously, valuation and structure. Sometimes if the valuation is important to you, sometimes you can get a higher valuation with a minority deal or a deal with a structure that provides the investor with some downside protection. So that's something to keep in mind. But even if you bring on a minority investor, that investor is going to look for certain governance protections that protect the minority investor around certain high-level business decisions like key management hires or nature of the business or the company's ability to raise more capital or bring on debt. So just because you're looking for a minority capital partner doesn't mean that you'll have the same freedom to make the business decisions that you had before. You will have certain restrictions or certain areas where the minority investor can veto. You want to focus, as highlighted before, you may want to focus on a minority investor who can add value. Again, you want to talk to investors and what their styles are. I mean, Friends Scholar, for example, will make a small minority investment in terms of percentage ownership, but again, oftentimes our involvement and our value add is significant relative to our percentage equity ownership, and that's just our model, and we're perfectly fine with that, and we look for companies and shareholders of companies who value that type of a model as well. And then you want to certainly address hold period and exit. Any investor, controller, minority is, at the time that they make the investment, is going to be thinking about, okay, 5 or 7 years from now, how do I get out in a way that is accretive? And so even if you bring on a minority investor, they will be looking for an exit over an agreed upon period of time. And so if you, the control shareholder, you've got to understand this, and you should have a plan to facilitate this transition and get them out in good times and in bad.
All right, great. Let's talk about the diligence process and what to expect. So again, I think you mentioned that before. What you should expect is to pull thousands of documents, and we highlight some of the key topics that will be heavily diligenced. So obviously financial results, customer, vendors, employee management team. Your potential new partner will do due diligence on all of those things, and really request a lot of documents, meetings. At the end of the day, they have to get comfortable with your company. So a couple of things that I wanted to mention from experience that you should think about is the number one question is, again, you're going to need to pull a lot of documents, so you're going to need help. And who do you tell within your team in terms of as a potential deal you may take on a partner, whether it's for, again, a complete control where you're going to give up control, or maybe it's a growth equity type of investment, but you're taking on a partner, so who should know? And usually most companies want to keep that confidential for a period of time, just in case the deal doesn't go through. But at the same time, you're going to need to tell your key people. Usually the management team will know that, more than likely some of your key people and your accounting staff will know. Obviously, the CFO, if you have one, will be part of the transaction, the people that know. If you don't have a CFO, it's your controller or the accounting manager, because again, they're going to be the one pulling out documents and also answering questions. The other thing you should think about it, again, in terms of who do you tell, is consider speaking to your key account managers, the ones that are handling your major clients, customer relationships, because you want to make sure that they're incentivized to stay if there is a deal, especially if there's a change in control. So you want to make sure that they're comfortable with a potential transaction. And really, it's up to you in terms of when do you tell, but it's something that you have to consider. And eventually, but usually closer to the end, it's talking to key customers and key suppliers in terms of, again, showing why this transaction is going to be great for them. The other thing you need to think about during the due diligence process is establishing a internal deal team. So, we mentioned you need to be well surrounded by a team of advisors, attorneys, bankers, CPAs. But really, internally, you need to have a deal team, people that will be accountable for pulling documents, answering questions. Again, expect a lot of requests from a lot of different parties. The private equity sponsor, they're going to have their deal team looking at things. They're going to hire attorneys and accountants and maybe other advisors. So it's going to be a lot of people. Some things that you may want to think about is that you can request from your potential partner to have somewhat of that process organized. A lot of the times, what we do is we send a comprehensive list that takes care of everybody's request. So we make sure that there's no redundancies in the request. The other thing that we do that's the best practice is doing status calls every week, so we know exactly where we stand, and you also know, what's coming. Because what you going to hate is having very long due diligence request lists and then having more requests 3 weeks later. We have to watch out for deal fatigue. So, and on the other hand, so they're going to be doing due diligence on you. You want to make sure that you do due diligence on them. It's a three-way street. So, a couple of things that, and Cheryl mentioned, earlier on, is you need to get comfortable with your potential partner and who it's going to be. I think at the end of the day, it needs to be somebody, and it's usually a team. It's more than one person, but it's some people that you like and you trust. I believe that chemistry, you're going to know that from the minute you meet somebody. You're either going to like them or not. But the trust part takes more time. And in the trust part, before it takes more time, and at the same time, you may not have a lot of time to get comfortable with your potential new partner. So let's say spend a lot of time together outside of your office, outside of your company. Have dinner, go golfing, do something that is out of the ordinary. You need to, and Sean mentioned that earlier, is do you share the same values? What's their vision for the company? Will they respect the way that you've done business over so many years? We have a lot of transactions where, the businesses that have been around for 50 years that are very anchored into their community and sponsor a lot of events locally. So you want to make sure that that's going to continue after, maybe somebody else is involved. The key thing is what happens when things get tough, because obviously, the economy is doing, fairly well, and your company, I'm sure, is doing very well. But what if you hit a rough patch? What happens then? And the best way to do this or to check is to do reference checks. So you should ask for a list of CEOs that your private equity partner has worked with, whether it's a current investment or a prior investment, and ask a lot of questions. How did it go? Give me the good, the bad, and the ugly. What type of value they bring to the table? How did they handle challenges? So, I think those interviews will be key in terms of getting you comfortable and over the hump of making a decision to bring in a partner or not. The other thing that, really the last thing that you should think about is there are going to be growing pains. It's private equity sponsors have a certain need for data and facts to make decisions. So they will need a different level of financial reporting from you post-closing and from your accounting team. So a couple of things is, it's going to be monthly. The other thing is it needs to be accurate, and that means in accordance with GAAP. And so if you accurate means if you do a lot of adjustment at the end of the year, those adjustments have to happen at the end of each month. So you have to review your closing process and make sure that those numbers are fairly accurate. The other thing is, okay, accurate is great, but if it's not timely, it's not going to be good enough. So you have to do accurate and timely. So it's a lot to do. I've had companies where they close the books 45 days after month end, and that's not something that would be appreciated. So you have to figure out, again, how to speed up your monthly closing process and have reporting that's satisfactory to your new partner. They will put something together, usually another way or some type of a dashboard with key metrics, key performance indicators, and they usually have some type of junior analyst that puts that together. But again, expect a different level of reporting and a different way to make decisions. It's based on data, facts, and not always gut feel. To close it out, we should talk about.
Yeah, I just want to touch on two things that you mentioned on slide 14. Mm-hmm. Firstly, the post-closing plan for the company and some of those growing pains. Oftentimes, private equity sponsors aren't expecting the management team to just do that on their own. Oftentimes, the private equity sponsor will offer some support and assistance, and also recommend that you get support and assistance from your advisors on those initiatives. And so it's not something where the company is kind of left out on an island with a checklist of things to do. Oftentimes, those are done collaboratively. And then the other point to add is also make sure as you're doing diligence on your investor, find out how the investment will be managed post-closing. Did you spend a lot of time with senior members of the firm during due diligence, and then will they stick with the investment, or will you be passed off to someone else at the company and at the team that you may not know as well? So obviously understanding who your point person will be going forward is also really important. So flipping to the next slide, slide 15, just to wrap this all together, an analogy that we use oftentimes at Friends Scholar is that bringing on an outside investor and partnering with an investor is like getting married. Many of the same ingredients for success in marriage are the same in this case. The keys to success that I would highlight are a shared vision for the future, joint agreement on your respective roles and a shared vision for your long-term business plan. Maintaining constructive, honest, and open communication in good times and in bad, and having mutual respect, which certainly comes into play and becomes very important when there's a differing of opinions, or, as I mentioned before, times are tough. Other things that can make it successful, you bring out the best in one another by contributing complementary skill sets. You should be bringing on an investor who adds value and makes your company and your management team the best they can be, and vice versa. And you have an agreed upon way at the outset to settle differences of opinion. And one way to do that is to put in place a very detailed shareholders or LLC agreement at the time of closing a deal, so that there's no confusion later on. And of course, not to end on a bad note, but as we all know, entering into a bad partnership can be expensive and emotionally painful and damaging to your business. And so going through all of these processes that we've discussed and doing a lot of upfront work can save you significant heartache at the end of the day, but also are very important steps to take to ensure the long-term success of your business.
That's right. So to close it out, so at the end of the day, next steps, what do you do? I'd say that, the first thing you should ask yourself is, who is your trusted advisor today? And, call them. Do they know, who to speak to that's in your industry that can, put you in the right direction? And I'd say, that our contact information is on the next page. So if you'd like to reach out to Cheryl and myself, we're happy to help out. Many times I have people reach out to me. There's a lot of deals that go through my desk. People reach out to me with questions, and I'm happy to help and point them in the right direction. Any last comments, Cheryl? I think, this was, unfortunately, we didn't have time for Q&A, but again, if you have any follow-up questions, I'd say email us. Our contact information is on page 18. Cheryl?
I thank you, Sylvie and Citrin Cooperman, for inviting Friends Scholar and myself to participate. It's been a pleasure, and I'm happy to have a follow-up conversation or answer any questions that folks might have offline.
All right. Thank you. Thanks, Cheryl, and thanks everyone. Goodbye.
We would appreciate it if you would complete that and provide your feedback. You will also receive a follow-up email within 24 to 48 hours with a link to view a recording of today's webinar. On behalf of Citrin Cooperman and Friends Scholar and our presenters, thank you for joining us today, and have a great rest of your day.